Hello, everyone. Welcome to episode 36 of Punch Card Investing. That's an impressive number, if I do say so myself. We've made it quite some time. Not quite a year, but we'll get there soon enough. Sorry I missed our post-New Year's stream. As you can see, we're down a couple folks since Tom is he's on holiday, and Brad unfortunately is sick, not with COVID, so he should be all right. And we will have Jason, the after dinner investor. He'll be joining us momentarily. He's taking care of a couple errands real quick, but will join us. We give him pretty short notice.
Phone with Charlie, right?
Right.
Discussing the best idea. Last minute.
We wanted to make sure he's really prepared for this best ideas episode. We like to do this every single quarter, kind of re-up our what our best ideas are. Maybe it's the same, maybe it's not, but we'll definitely be getting into that. And always we'll be trying to answer your questions as well, especially towards the latter half of the episode. So get those questions going in the chat. And before we start, and before I forget, be sure to smash that like button, because that goes a long way towards helping out the channel and exposing this to new people, which is always great. So while we wait for Jason to step in, how are you guys? I haven't talked to you guys in a month now. So how are your holidays? How was the new year?
Yeah, it's been pretty good. I did last week's episode, but before that, it's been about a month since I was actually on the show. So first time seeing you in a while. The holiday break was good. Got away to the beach, which is always nice here in Australia, although it's very hot here at the moment.
It is not hot here in Chicago. A couple weeks ago,
what does hot look like for you?
So hot here is about a 40-degree Celsius day. No idea what that is in Fahrenheit, and I don't know what you even use actually, Karam.
Yeah, Celsius. We use Celsius too.
Yeah. The right one, the normal
one. For
one.
my fellow Americans, that's 104 Fahrenheit. Jeez, that is intense.
We get about a month straight of 40-degree days. That's our summer.
Is it at least a dry heat, or is it real muggy too and humid?
Now, where I am, it's a dry heat, so that helps.
That helps a little bit. So you got nothing to worry about.
Yeah.
Oh, Vishal says Chicago is never hot. I disagree. It gets up to there. Not for a month straight, but we'll have a week usually during the summer that's up in the 100-degree range, high 90s, which would be like 30, 35-ish. So maybe not quite 40. That would be killing people with the humidity in Chicago. So
it seems like it's always snowing in Chicago. Like that's the first idea you get. Like
we've only had like 2 snowfalls this winter. It's been super mild. I mean, knock on wood. But we had 1 week that was in. I have my Celsius converter up. But it would have been negative. Yeah, about -10, -15 Celsius.
For the rest of the world.
Wow.
Yeah, which would be about 10 degrees Fahrenheit. We had that for a good week, which was not pleasant. And we're back up towards freezing right now, which is
like... Does any other country use Fahrenheit?
Do any? I don't know. Not many. Fahrenheit.
What a stupid thing to do.
There's a lot of stupid things, Oh, there are others. The Bahamas, Belize, the Cayman Islands, the U.S., the Marshall Islands, basically U.S. territories. So yeah, anything within the U.S. sphere, it seems.
Speaking of Cayman Islands, there's quite a few questions up about Alibaba. So
is that a best idea for anyone with Charlie doubling down? I know that was last week's episode. Karan, you looked like that was. I'll take that as a no.
I don't know what to say. I have like 1/3 of my portfolio on it. I'm just like, okay, cool. Let's just wait.
That seems to be everyone in the boat right now. It seems like it's turned the corner. It's up towards like 130 now after the 110 low or whatever it was. So hey, maybe there's greener pastures if you're not looking to add. We shall see. I guess why don't we go ahead and just start diving into what our best ideas are. Jason should be on momentarily. Who wants to take a stab at it? If it's not Baba, what are we thinking? Are we still looking at China? Are we looking at something else? Frank, I'm going to pick on you because you recently made an acquisition, or not an acquisition, you didn't buy the whole company, but you added to your
I wish.
portfolio.
Close.
Yeah. And why don't you take us through that one? Because this one sounds really interesting.
So I'll just share my screen with you as well so I can talk through some of the numbers because that's the main appeal to this one. That should come through in a second. But the company is New Zealand Media and Entertainment. It's, like the name says, a media company in New Zealand. It's a bit of a special situation investment. So I've got some of the numbers up on the board, but the main thing I want you to see here is the segments. So there's 3 segments to the business. Audio, which is just your radio business, and they also have a digital aspect to that with podcasting. The publishing segment, which is your typical newspaper. It's the main part of the business. It's most of the revenue, and they're transitioning to a digital subscription service business at the moment. That's the main part of the thesis. As the dying newspaper business fades away, it gets replaced with digital, higher margin, higher quality business. Which deserves a higher multiple in the long term, which they haven't really got yet. It has been re-rated slightly over the past 6 months or so, but that's the main aspect of the business. Then they also have what's called One Roof, which is a real estate listing type business. If you're Australian, realestate.com is probably the best example, or maybe a part of Zillow in America. It's that type of business. Although given it's a very small part of the business at the moment, but there is potential upside from that aspect as well. But overall, it's a crappy business with a hopefully decent business that is underlying and taking over to become a more high margin, high return business. So you can see the revenue numbers, the margin numbers I've put down here. And for the 2023 column, these are the margins that management have guided. They actually give a range, and this is the low end of their range, which I think even their range, it could go well and truly beyond that. So I think management have been conservative, and then I'm using the conservative end of their already conservative numbers. So the special situation here is as we transition, we get a multiple re-rate from these margins increasing, which gets us to our free cash flow numbers down the bottom. But the important side is the right-hand side of the spreadsheet here. You can see my returns down the bottom. Over 1 year, I'm expecting, if all goes well, a 62% return and 100% return if I hold that over for 2 years. The free cash flow is going to increase fairly dramatically as these margins improve. And they've initiated a buyback that starts February this year, and that's an 11% of the market cap buyback, which is going to drive that earnings per share growth or free cash flow per share growth very significantly. So I have 30% there on free cash flow per share growth, just over 1 year. And that's, again, on the conservative end. It could go a lot higher than that. And then for my estimation for 2023, I didn't assume any more buybacks, but they're going to have even more free cash flow. So it is likely that that continues. But even without, we get about another 10% per share free cash flow. The dividend yield is kind of the backup that you get here. You get about a 5% yield for this year. Even if we don't get a multiple re-rate, you get 5% return, which isn't bad. It's a bit of an opportunity cost if the multiple goes nowhere, but overall, I don't think that's anything to be too concerned about. The multiple I'm using here is I'm using EV to operating EBITDA, which is just a slight adjustment on their EBITDA number, but it's the best for comparisons. I'm using a 7 for this year and an 8 for next year, which compared to competitors around the world is still extremely low. So the New York Times is a similar business model where they transitioned away from a dying media business towards this digital online subscriptions and online advertising business. And they traded about 25 times EBITDA, which I'm not saying this small New Zealand business deserves that high of a multiple, but that's kind of the top end of the range that you could see if everything was executed perfectly. They have much more of a dominant market share compared to a business like that. In New Zealand, I think it's around 70% of the New Zealand population they access on a daily business between their different businesses. So that helps the transition towards this digital subscription kind of model, because they can advertise so easily, whether it's through the old media or new media, to boost those subscriptions. If you look at Australian comps, most of them are trading at about 10 times EBITDA, up to around 12 to 13 times EBITDA for some of the media businesses. So still higher than the multiples, I'm assuming. And I'm still getting, if all plays out, 100% return. I'll just adjust these multiples to, say, 10 and 12, which is also possible. And then you can see the IRR jumps up fairly significantly. And I don't think that's out of the question. And again, I think all of that is conservative. So boosting, I'll put the multiples back to how they are, and I think that's the conservative end of the valuation. But that's the thesis in a nutshell, I guess.
No, before I ask a question, hi Jason, welcome.
Hey guys, thanks for having me. Sorry I'm a little late.
No problem. How was dinner? Was it all good?
Well, have you seen my Twitter tonight?
Oh, I haven't. What was it?
It was 4 fish sticks breaded and some broccoli. A lot of broccoli. Half the plate was broccoli.
All right,
So,
making up for that balance.
yeah. It was okay. It was okay.
Wonderful. Well, it's good to have you here.
So much
Thank
broccoli,
you.
your shirt turned green. What is this like?
So did yours.
Yeah, you guys are like the exact shade of green right now.
We coordinated before the streams.
Yeah. So Frank, I got a question here, because you're talking about the conservative side. I think the multiples would make sense if this happened, but my question is on where is the margin expansion really coming from? Is it as simple as just, okay, we're moving things online and somehow cutting costs? Like where's the, like, we see some significant expansion in the audio, like podcasting side, whatever you want to, audio, radio, fairly, not all that significant in publishing. And then very significant with One Roof. Granted, that's a smaller portion of the business. Like, where is that expansion coming from in a decent case?
Well, One Roof I'll throw out. You could almost just cross that out of the valuation. It would make a difference. It's that small on a basis, but that's reinvesting a lot back in the business. It's small. They're trying to grow it quickly. So margins just automatically improve just from stop spending so much on reinvestment for that aspect. The publishing side comes directly from switching from the print model to the digital model. They also have a combination. I forget what they call it, but it's the print and digital combined, which some people, I don't know why, but they do subscribe to that as well. But yeah, it's switching from a low margin newspaper print business to the digital side of the business. And when it comes to advertising, it's cheaper to put it online as well slightly. So margins improve all around the board, really. There also is some cost reductions kind of happening, but the bulk of it comes from that transition. And same for audio revenue. It comes mostly from the podcasting aspect of the business as well. But again, the audio, I wouldn't be too concerned if nothing happened there. If it stayed how it was, even declined slightly, I don't think that matters. I didn't mention the growth numbers I put out for each segment. I've put 0 for audio. You could put a decline on that if you wanted to. And I've only put 2% growth for the publishing revenue. You could round that down to 0 and still get just as good of a return. It doesn't matter as long as the free cash flow per share is growing. With the buybacks, that's almost a guarantee that on a per share basis it grows. And if margins improve, then it grows significantly.
Frank, so did they develop One Roof, or is it something they acquired? How did that come about?
I'm actually not sure of the answer to that question. It's a thing I've looked at very little. I know it's growing at incredible rates, but I've used 15% there. It's been growing at about 60 or 70% or something. But no, I haven't looked into that aspect of the business in detail at all.
I got a question for Frank. So Frank, what percent of your portfolio would you feel comfortable with this company? Like, I'm sure you made maybe something like a 5% or 6%, 7% bet, maybe. But like, what would you be willing to go up to? Maybe say the price dropped 30% for no reason. Would you feel comfortable at 20%, or is this going to stay a small position?
So at the moment, it's about a 6 to 7% position, roughly. I do want to increase that position, but I'm kind of waiting on. There's an activist shareholder involved, which was part of this kind of transition and part of the appeal. Owns around 19% of the business and just recently sold a chunk. So his 19% ownership went down to about 16.5%. So he still owns a huge part of the business. I'm kind of concerned on why he's doing that. A big push of his was to get these buybacks happening. And if he starts to sell shares while they're buying back in an illiquid company, I'll sell out straight away. Okay. That would be a huge red flag. So it really matters on what he's doing there for sure. But he is up about 100 and something % on his position since buying. So hopefully he just realized some of those gains, and that's the reason for the sell. But if it got a lot cheaper and he hasn't changed his position, then I would probably be willing to go up towards a 15, maybe 20% bet. I passed on the company about 6 months ago at a price that if I knew what I knew now, I would have bet big, but I missed that opportunity. So it was trading at about 3 times EBITDA at the time, which is
what changed
insane.
In your knowledge?
When I first come across the business, actually saw it on Twitter. A guy named Asymmetric Dundo Bets pitched it. And I read the thread, thought it sounded a little bit interesting. I read through the investor presentation and just wasn't interested at all. It just seemed like a dying business. I was looking for long-term compounders, really heavily focused on that at the time, and didn't really look through the special situation kind of lens. Mm-hmm. So I just missed everything about the appeal. But then a follower of mine, actually, Shane, I forget his Twitter handle, but he pitched it to me again a few weeks ago, and yeah, I realized the value of it, and I took a position.
So last question for me. What has your audience reaction been in the comments and stuff? Do you read those? Are they bullish on this? Do they not like the idea? What feedback are you getting? I'm just curious.
I actually haven't noticed any major feedback. I would assume that it's not as appealing as some of the other positions I take. My audience reacts to a Tencent or an Alibaba position. That's what they like to see me talk about. But when it's a boring, dying media business in New Zealand with a $300 million market cap, they don't get too excited about that.
Gotcha.
What are the risks here? Like the major risks, just, I doubt they would like lose market share, but is it just the market shrinking? They don't switch to digital fast enough, and the print business just kind of almost eats the business alive because it's too expensive. Is that kind of the main risk, or is there something else?
Yeah, their market position is so dominant. I don't think they could lose share. So you're right. I don't think that's a risk. But if the main risk is if they can't switch to this digital model, if it fails or doesn't grow much from here, then the dying publishing business is just going to kill them. That's a huge part of their revenue. So
are they underway with this transition already? Like, do we have some sort of track record of the transition going well? Or is this like kind of pretty new still?
Yeah, digital subs, it's about 3 or 4 years it's been ongoing, but the bulk of it's the last 2 years. And the digital subscribers have grown at about 50%, I want to say.
Good.
I don't have the exact numbers in front of me, but it's around that mark. And the print side of it is declining almost as quick. So realistically, you don't need revenues to grow, but it needs to grow as fast as the publishing side of it or the print side of it is declining.
Because meanwhile, expenses will decrease, revenues will be stagnant, and you're up on profits. And that's really what matters. So that makes sense.
Yeah. So that's the main risk. And then again, this shareholder, he owns 16% of the company. If he's purposely making a illiquid company more liquid through these buybacks and uses that to sell out, then that's just a huge red flag. And that would be time to go as well.
Activist, or what's exactly?
He's gone kind of activist on this position, and management were kind of really doing nothing. They were more recently, they started to kind of push the appeal to the business to investors through investor presentations and things like that. Management aren't large shareholders. They weren't really incentivized. They still aren't really incentivized to do exceptionally well. So this large shareholders really encouraged that. A lot of the larger shareholders in the past were like Australian investment firms. nowhere near the size of this guy, but they've all exited the position as it's a dying business. And then I guess he kind of seen the value, stepped in, and is trying to realize that value and uncover the underlying value in the business that's already there, really.
Do you have any hope?
history?
Oh, sorry, Karan, go ahead.
Yeah, do you know anything about like the history of this person who's come into the company? Like, does he have past experience of getting into companies or somewhat of an activist role?
No, I know he's like investment style. He looks for these kind of undervalued, concentrated type positions, but I don't know how much he's played activist roles in the past. And he's not like heavily activist in this one. It's kind of just pushing management to do what they should be doing by common sense.
So, Frank, do you have any hopes or any thoughts that a bigger media company is going to come buy this company? Because I know in the United States, there's some company out there that's like buying a bunch of like local newspapers, and their whole thesis is that if we can keep getting digital subscribers across tons and tons of markets, we're going to make money. And they're like buying a lot of people. Do you think that could happen to this company?
Yeah, that's what's already happened with like radio. It's happened with a lot of newspapers. So yeah, why wouldn't like a foreign?
It could be a good thing.
Yeah, foreign competitor rolls in. What would happen? I
was about to say it'd probably be a great thing as long as they paid even slightly higher of a multiple than what it trades for on the market. Which, I'm assuming management. Well, any company, they're going to pay more for it because it's transitioning to a higher multiple business anyway. So I don't think you get an offer that's equal to the market value. So it wouldn't be the worst thing that happened. I don't know how it would go with like regulations and stuff. I know they already have tried to buy out other businesses in New Zealand and have been pushed back on that because they'd have too much of a monopoly. I don't know if they would want that to be split up. I just don't know how that would sit with regulations or anything, but it's a possibility, and I don't think it's a bad thing if it did happen.
Fair to say you traded your Twitter for this stock?
Yeah, I've been trimming Twitter for about a year now, and I went into Twitter on a bit of a COVID play, I guess, a beneficiary from people shifting online pretty quickly. It worked out well, but it's not the type of company that sits well with me. I think it can still do really well. The optionality of the business of Twitter is insane, but I think it's just very uncertain, and I'd rather my money elsewhere.
Frank. It's been insane for like 5 years now with Twitter. They have a lot of potential, and they've always had a lot of potential. And that's
their mode is so strong. It's so hard for other people to leave. And
if management execute at Twitter, it's going to be a huge return. Like there's so many different ways they can improve revenues, whether it's through advertising, which is compared to other social media businesses is terrible. But then so many different forms of optionality of increasing monetization. It could be well and truly higher than what it's worth at the moment. But there's no certainty of that happening. So it is speculative, which is why I would rather my money elsewhere.
Frank, I'm an investing with Frank Tabor. I'm a YouTube channel subscriber. I follow you on Twitter, and I'm a newsletter subscriber, and I can't wait for the 10-cent edition to come out on the newsletter. So I'm a huge fan. The passion you have for these turnaround plays, small stocks, special situations, this evolution of yours, I've been watching. It's very exciting to see you go down this road. Are you comfortable being like 100% in these kind of small cap special situation companies? Would you ever do that? Or do you still see a place in your portfolio, like a big place for the big mega cap companies? What are your thoughts on that? Because I struggle with that myself.
Yeah, the way I've always thought about it is roughly I would like a 60-40% split, 60% being compounders, long-term positions that I can hold for a long time. The typical high return invested capital, competitive advantage, great management, all of that stuff. Because that's just the tax efficiency behind that is just very beneficial. And then I would like 40% into these special situations, but I think they're harder to come by. So at the moment, I have 6% of my portfolio in special situation. The rest are all compounders. So if there was enough opportunities, like it really depends on what the market's doing, I guess, whatever it offers you. But no, I wouldn't want to have a portfolio full of these. There's a couple of positions in my portfolio already that I don't plan on selling for the next 10 years at least. And I wouldn't exit those positions just to, I wouldn't exit those just to buy a special situation. So
good thoughts there. I'm in the same boat where I really like the small cap special situation asset plays turnarounds. I see the value in them. I've seen it myself with my portfolio. I see these people you tweet about their returns. At the same time, there's that wealth preservation feeling where I like having a bunch of money in something like Apple. It just feels very safe, and if that can grow too, all the better. So I like a mix as well.
Yeah, special situations are a higher risk, higher return strategy. If you pull off a portfolio of concentrated special situations, that's how you get returns well over 100% for a year. Like some of the people I shared on Twitter, I actually just recorded a podcast with a guy named Paul. I can't pronounce his last name, but Paul from Germany. He runs a very concentrated special situation portfolio. About half of his money is in one position, and he just had 142% return last year from this type of stuff. And you're not going to get that from a portfolio of compounders at all. Best case scenario, you get 7 compounders that return 30 to 40%. That would be incredible.
Yeah.
With a portfolio full of compounders. And if you can do 20% for 20 years, then that's amazing.
You're Warren Buffett.
While you're younger and can take on more risk, if you have the ability to find a lot of special situations, then it's probably worth doing. But I kind of fit in the middle there where I play a bit of both.
And it makes sense with our small funds, where we're not having to move $100 billion in cash. So putting some significant portion of your net worth in a small cap special situation stock could really move the needle. And you can let those things play out. Whereas like a Berkshire isn't going to be able to do this. And because in order to move the needle, they need to buy the whole company, or they just wouldn't even look at it at all. It's just not worth their time. So that's, we always stress that advantage. And Frank, I know you definitely appreciate that. So maybe it's just kind of a size thing. And that's why it just doesn't get talked about as much, because the big funds aren't looking at this sort of stuff most of the time.
Yeah. And I think really low multiples, like deep value matters here too. Like something re-rating from 3 times cash flow to 9 times cash flow, you get a triple on your money right there. But if it's trading at 20 times cash flows, then to get to 60 is just insane. So, it's just not likely. So valuation and size.
We're seeing it
matters.
in some stocks right now.
You could convince Kathy to buy it, and then she might.
Yeah, right. Yeah. No. That might be the example of like kind of investing in smaller cap stocks with a fund, and how it, because of all the inflows and outflows, it just like dramatically moves the price from day to day. So that's why it's not very feasible to do at scale. That's at least that's my sense of it.
And last thing on that before we move on, someone just asked about the debt at New Zealand Media. They've actually been deleveraging for like the last 3 years. They went from a huge net debt position to now just reaching net cash. So
beautiful.
Debt is far less concerning. That's probably a big part of the share price movement recently, is that it was deleveraged. So that took away a lot of the risk. And then, the same reasons why I expect it to keep going from here also had a factor in that as well.
And to what Cresty says, is special situation basically what Graham style investing, like cigar butt style? I think it's definitely a like the kind of net sort of thing. It's like a subset of it. I think would be the best way to put it.
The best thing for special situations is an early Joel Greenblatt. If you read a book like You Can Be a Stock Market Genius, or even better almost is the Joel Greenblatt lectures from Columbia, I'm guessing, in around 2005. He was lecturing there. And there's some, if you just type Joel Greenblatt class notes, it'll come up in Google. It's about 300 pages of his lecture notes, essentially. And that's probably one of the most valuable resources for special situation investing. But it's not too far off a Ben Graham type approach. Yeah. There are some differences, though.
Well, that's a good one. It's hard to follow that one up because that's one that was I had no idea about until you brought it up, Frank, and it's enticing. Like I'm looking pretty closely at it now, or at least I really want to. Maybe I'll clone you, Frank. You'll be one of my shameless clones.
All right, if you're going to clone them, let's see a 7% position in it then.
Yeah, exact cloning.
Was that
How many
I
positions
was,
are you down to?
What was that? Sorry.
What's that? Say
Go ahead,
again,
Jason.
Con?
I was asking, was that the first stock? Because I was a little late, and then I think Ron was asking you, Jack, how many positions you have.
Oh, I think it's the same as last time. Let me pull up the old tracker. I'm in the 20s, which is far better than 100. So, here we are.
And yeah, that was the first stock. Jason.
Okay, cool.
And yeah. See, we got 20 or 19 holdings, but a handful are like commodities, which you can kind of count as like a basket.
Gold has been very quiet the last
It has.
5 years. Nobody
I
cares
actually need to
about it
update this a
anymore.
little bit because I've made some purchases recently. Like Turtle Beach is up to 12 grand. I see someone's in here. Hello. I need to add a little bit, but all the holdings are the same. Just I've added to some.
And you've definitely fairly heavily weighted towards your top 5 or 6 positions
Yeah,
as
let's
well.
go down to that. Yeah, here you go. Granted, Purchasing Square Holdings is like a fund with multiple holdings in it, but we'll count it as one. Same goes for Berkshire down here. Otherwise, Equity Commonwealth is big. Turtle Beach is now bigger. Foot Locker added a little bit too. Smith & Wesson added a tiny bit too, and otherwise everything else should be about the same. So yeah.
Jack, what's stopping you from converting Equity Commonwealth into Tencent?
So I'm a little hesitant on China exposure because I already have a decent amount in Alibaba. It's almost 5% of the portfolio. And I don't know if I really want to go much higher than that. And if I were to do something, maybe I would convert Baba into Tencent a la Monish Pabrai because I got, be a nice little tax loss move. But man, I'm not like particularly excited to just like keep pouring the portfolio into China because it's a different set of risks and that I'm not entirely comfortable with to where it'd make up a huge portion of the portfolio yet. Maybe that'll change.
I see Jason has something.
Oh no, someone was just asking about Brad, and I just was thinking about Brad. Put a smile on my face, missing me some Brad. I was just thinking of the way he'll be like on the show, and like when there's moments of silence, he'll be like, "So, anything else in the market you guys thinking about?" That's his hosting style, Jack. When you're gone,
Brad's a great guy. We all love Brad. I mean, that was the question. But Jason, when I was on your podcast recently, you put out a feeler on Twitter like, "Hey, ask questions for Jack and I's conversation." And the first question was, "When are you going to have Brad on the show?"
Yep, and they included you in the comment there, the tweet. That was quite rude.
Hey, what's up, stock compounders? Brad here. Should we get into the next one then?
I'm not following that. I refuse to follow that.
I have no idea. It's done. Finished.
No,
Just a quick question for Jason or maybe Jack. Fidelity. I think Jason uses Fidelity. Does that have access to the Australian or New Zealand market?
Let me do a little search.
Someone asked
right
a question
here.
about
I was actually checking to see if, like, just while you were talking, Frank, and it doesn't pop up when you search the ticker. So I'm not sure. Maybe it's a different ticker symbol, but if you do nzm.ax or nzm.
You should.
NZX.
I'm not sure about that specific stock, but if you Google international stock trading Fidelity, they have, or go to fidelity.com/stock-trading/international-stock-trading. It shows the countries they do business in. You might have pulled it up already. I'm not looking at the screen. Oh no,
that would be like the next step would be call the trading desk or figure out a way to get it. I'm sure they would, since it's both listed in Australia and New Zealand, which I'm sure Fidelity's cool with. So, shouldn't
It's
be
so easy to be an investor these days. There's so much information online. There's so many great people, and it's so easy to get your hands on international stocks like this with like no fee or hardly any fees.
I really can't imagine like investing in like, I don't know, the 70s where like you literally have to call to someone, know about the stock beforehand, or just get pitched on something.
Pay them money.
That's the only way you're getting it, unless like, and it's way harder. Like you could search up a whole industry and look at every stock right now, like in an instant. You don't need a book. You don't need to dig. It's so much easier. Control F. Like it's amazing how much more powerful it is to what you were saying, Jason.
Yeah.
And it makes it a lot harder to outperform the market too, because we've lost that informational edge that you could once have.
Theoretically.
I'm talking to Jordan Nell, who I only know through a really detailed write-up he did on Tencent. I'm doing a podcast with him this week, and he wrote a bit about that in his shareholder letter, about that informational edge is just gone. So he's saying to get that, you need to be probably in the top 1% of people that understand that business to even come close to having an edge.
Well,
which is pretty hard to do for someone like us.
I'm not as worried about the informational edge because I feel like in something like Colgate, the toothpaste company, or Coca-Cola, like everyone knows what's going on. But the company, New Zealand Media, you just talked about, you probably, I don't know, say after the first 5 hours of work on that company, you're now in the top 1%. And you just think about the whole market out there, the institutionals with big money that can't invest in it. It's not only them. It's like there's so many millionaire next door kind of people who buy stocks and all that kind of stuff that just they would never, ever put their money in a New Zealand newspaper company. And I just feel like there's a lot there's more information out there, but it's kind of like people are the same. And there's just a lot of stuff people don't want to touch.
And also, even if there's like there's no like distinct informational edge most of the time, the emotional edge is like perhaps even it's like magnified by the ability to easily get into the market. Like we see just these euphoric highs that those existed before, but they seem to be perhaps more prolonged. And I would imagine that crashes would be also more dramatic because people can more easily sell. They're paying attention to it all the time. And that's like the big thing that swings markets. It's emotion. So even if like, the company information, you're not looking at it when you're panic selling. So, I think it evens out a good bit, though. Maybe I don't want to like overemphasize that, like, okay, there's no edge now and the markets are efficient, because I think we all don't believe that. So
I should clear up. I think there's lots of edges we have, but specifically informational edge is limited. Right. And I think Jason's point is the best one, to look at smaller liquid companies that the majority of money in the market can't look at. Is the only place I think you can find a true informational edge. Yeah. Like there's nothing I'm going to find out about Tencent that 100 other analysts don't know 10 times more. I don't have as much of an edge there. My only edge there is really that people are scared of investing in China.
Right. Emotional edge.
But when it comes to information wise, there's a lot of people that understand that business well and truly more than me.
Watch out for another edge that's available to people like us. There's an edge sometimes where people understand that there's stocks that you can buy, but they want nothing to do with that industry. That happened to me with Ring Energy and oil and gas, like in 2020. 2020, I guess, because of like political reasons and also because of the virus and stuff. So much of the market didn't want oil and gas at all. They just didn't even want to look at it, even if they knew there was a bunch of value there. And I think that can be an edge from time to time. Like markets are going to get unpopular. I've heard in the last few months that's going on with maybe it's not anymore with all the inflation, but I think commodities for a while, like mining companies and stuff, were pretty ignored. So that can happen from time to time.
So that tweet that you mentioned earlier, I shared 3 people with the best investment returns I could come across, and they were all about 140% for last year. In the comments, someone shared with me, Josh Young is his name. He runs a fund, and it's only oil and gas, and he had a 300-something% return last year. So he definitely took advantage of that edge.
Yep, totally makes sense.
Shall we get into another holding now, or another best idea?
We're 40 minutes in and we've only got through one. So
yeah, we've got one.
Jack, you want to take the next idea?
I guess so. Like I don't want to say Turtle Beach again, but that's what it got back down into the low 20s, and that's what I've been buying the most of. But the other my three newest holdings that I've really added in the last month have been Foot Locker, Sleep Number, and Smith and Wesson. Those have been my three big additions. While I've been subtracting a number of other holdings. But the most money I diverted, or the most money I invested this past month at least, has been towards Turtle Beach because it's back in the low 20s. And I think, here, let me pull up their. There's a lot of people. My general thesis of Turtle Beach is that it has nice cash flow, not a bunch of debt. They should be able to grow at a decent clip as long as like the video game industry does okay, and as they move into the PC space away from like console headsets, because that's kind of their main focus, or has been for a long time.
Jack, are they net cash or like very low debt?
Yeah, they have no debt. I'm going to actually show their balance sheet because some interesting things happened in the last couple of quarters that maybe have shied some people away because their cash flow looks really low all of a sudden because they have been adding a bunch to their inventories, preparing for this Q4, and partly because of supply chain issues and all this stuff. So they put a bunch of their cash and cash flow from the last 2 quarters into inventory, and they have like twice as much that they normally have, or at least they did going into Q4. So it's not as though it was, the cash was just burned. It was literally moved into inventory. And here we go. Inventory right here. You can see how much way higher than it normally is. Yeah, here you go. Here's a bar chart. Like, look how much higher their inventory is compared to what it has been. And 2020 was like a tremendous year for them. So they needed a lot. And it's still higher than that because they were trying to prep for this Q4. So they put a lot of money towards that, and it made their cash flow look really low. And we'll see what happens this Q4. This, I think, will be really telling for the direction the company goes in for the next probably couple of years. If they can navigate these supply chain issues, keep expanding their PC market stuff, maybe make some acquisitions like they have been, while not diluting shareholders too hard in the meantime, which is probably the biggest problem with Turtle Beach. So
I was going to say that the two reasons I passed on Turtle Beach a while back was firstly dilution, which I think is about, if you average it out, it's around 10% or so per year. So it's significant dilution. Mm-hmm. The other thing was the cyclicality nature of that doesn't come from their business. It's more so from the console cycles that kind of happen, which with headsets, which is the main portion of their revenue, they are reliant on new consoles, as that's typically when people also buy new headsets. So I think they're at the peak of that cycle possibly right now with the new consoles that have come out. So I don't know how that looks for the next 4 or 5 years. I guess if you're a long-term shareholder, that matters less. But yeah, short term, I don't know how that plays out.
That definitely is. And they recognize that, which is something that I definitely appreciate with the company, in that they realize like, okay, this is very cyclical. We're trying to move into something probably more, sustainable, like PC accessories, which is why they've made the acquisitions they have with yeah, exactly. And that segment of their business keeps growing at a pretty, I think last year they grew their PC market, or their PC accessory business, by like 15 to 20%. So it's like a significant growth rate there, even if like the headphone segment, it keeps throwing off cash flow, almost like a dividend for the company. It's not going to grow very much, and it's very cyclical. But if they can kind of rotate some of that value into PC, then I think that's where their real growth trajectory is. And so far, so good there. The question is how far they can take that, of course.
Jack, I love getting into companies that have like offers for their business at a much higher share price than the current price. So my question is to you, how real is that thing going on? Is that a real offer? Are there other people making offers, or is it just one company that the company probably won't end up selling itself to?
We were talking about it just before the show, actually, Karan and I.
Because it tempts me. It tempts me so much.
Yeah. So this has been going on for a few months. Like Turtle Beach has had this apparently really great looking offer from the Donerail Group, who I had never heard of before this whole thing started. And apparently they're a decent sized shareholder. They claim they own like 5% of the company, when apparently they really just have a bunch of options and then own a lesser share. I'm not sure the exact allocation, but they're trying to say that they're trying to buy Turtle Beach for over $30 a share. Right now it's trading at like 21, and Turtle Beach is saying, like, no, you haven't shown us your financials. They actually shared what they had showed, and it didn't show that they had enough funding to actually make the acquisition. And the reason Donerail says they want to make this acquisition is so they can take the company in a different strategic direction. So that's the reason for not just buying shares on the open market. They don't want to bid themselves up. They want to get like a majority share. But it seems pretty thin. And they're going on this big PR campaign talking about how Turtle Beach isn't giving them a fair shake and all this. And it sounds, it's pretty fishy, let's say. So I'm not really counting on it. I mean, it's a good sign, I guess, that like, there's some sort of interest to pump the share price, but I wouldn't take it too seriously unless there's more proof. At least that's not what I'm.
I withdraw my question. I remember you made a video reading the statement that Turtle Beach released in response. And
this one right here, yep.
It was strong, and it convinced me that I don't need to be thinking about this offer. That it's not likely. That was my opinion.
When I first heard it, I thought, oh, like this is really interesting, and it shows that like the Turtle Beach board is in line with like a long-term shareholder, but that probably was not the case, especially seeing what's happened as this is matured into nothing.
Do you think Apple could ever buy them, or like where do they fit in? Is there bigger tech companies that they make sense to fit into them?
Kind of like what we were talking about with NZM, that is a potential route for Turtle Beach for like a potential acquisition at some point. That's happened within the gaming space. I mean, they're doing that themselves. They're buying smaller accessory companies like Rocat, and then also with Neat Microphones, maybe they'll do something else. But they're still not huge. They're $300 million. It's a significant share. But that could be where they end up long term. A larger gaming or tech company will go ahead and buy them to open up they just want some console headset market share. They want to get into the PC market share if Turtle Beach builds that up big enough. It's a potential. They haven't really said that they're trying to do that. Donerail is suggesting that that's what will happen for sure, but take it with a grain of salt.
And why is it cyclical? What is that about?
So that is with consoles, like take the PS5 and the new Xbox recently coming out, that would drive a lot of their console headset sales. And console headsets are the majority of their revenue right now, or I think just over half. I need to check on what it is now that the PC market is growing. But it's a very significant portion of their revenues and has been for a long time. So as new consoles come out, they're often literally paired in the box with the new consoles. So they've had this kind of recurring revenue stream whenever new consoles come out because of that. And that's great. But when there's no new consoles, you're not going to do anything. Or if there are problems with distributing consoles, that's another problem that we're seeing right now. You're not going to get as much sales there. So it's kind of like, I know Frank's done some analysis on like Nintendo, same sort of problem with like cyclicality. They rely a lot on actual consoles being sold. This is sort of tangentially related to that. They rely on consoles being sold so that people need accessories for their consoles. And that's why they want to get into the PC space, which is it decouples a bit from that.
Well, last question for me. Pandemic, everyone's working from home, blah, blah, blah. Do they have a role in that growth probably of headsets for professionals when they're working at their computer? Do they have any market share there, or is it a separate thing?
I don't know if they segment that out. It definitely falls under the gaming niche, but you could use them for whatever. They have some modest looking ones as well as like the crazy gamer looking ones.
What do you think of mine? Do you like them?
Yeah, they're all right. Wonderful.
You're not going to get any money from Karan.
No.
You won't be pleased to know that I used to have a Turtle Beach headset, and I just replaced my headset, and it's no longer Turtle Beach.
Oh, no.
Sell the stock.
I know if we're talking about more on like the professional side, like the Neat Microphone thing is less gaming focused. It's more like podcasting and kind of like broadcast focused. They don't really market that much to gamers from what I've seen. So that's kind of where you're going to see the separation is in the different businesses that they might acquire.
Jack, how's Turtle Beach stacked up against, say, Logitech or Corsair? Like, Those are the two competitors that come to mind. Are there others?
It kind of depends on what you're looking at, because in the console headset space, that they've had that locked for a long time, and that's probably not going anywhere. It's in the PC space, yeah. There's going to be serious competition there. So, I actually looked at Corsair briefly, because it's the same space, same general kind of growth trajectories, but I just didn't like the price it was at. So maybe if Corsair comes down, I would be more interested in that. But and I also like the fact that Turtle Beach has good cash flows and has for a while, and had a really nice balance sheet position. So that was the big reason I went for that over something like a Corsair. Not that Corsair is a bad company by any means. So we shall see there.
I think Corsair was also getting into like lighting and all sorts of other stuff. So they all seem to be diversifying away from
Consoles.
like it's related diversification, unrelated to some extent. I don't know. How do you guys see that? Is it sensible diversification, or they're just diversifying for the sake of diversifying?
I think long term they have to diversify away from consoles, because consoles will be virtually non-existent at some point. It'll be some type of cloud-based thing, or switch more towards PC type gaming. So they have to diversify away from it. There's a company in Southeast Asia called Razer, which is another competitor in the headset space, but they've diversified completely away into kind of financials, as well as like actually selling laptops. Like they've gone fully down the PC route as well, because it is a limited amount of growth within the gaming headset market.
Mm-hmm.
Jack, I
Razer's
like this.
laptops look cool. Yeah.
I like this question that Ba asked you. Why do you like Foot Locker?
So this is an interesting one. I was kind of hesitant on retail in general, naturally, just because who would invest in retail, but there's a pretty significant kind of like culture following with Foot Locker that I think is going to continue to grow. They have a pretty good handle on, like, not a handle, but they're definitely in tune with kind of the sneaker culture in the US especially. The question is, how much can they grow internationally? Because I don't think they can grow that much more in the US, and they're trying to do that. They've made some acquisitions recently, especially focused on like Japan. Also in the West Coast as well, beyond just shoes, but kind of like clothing and accessories, that sort of stuff. But shoes is going to be their big thing. And they are actually consolidating their store portfolio, because that's what every retailer is doing. And it's and their revenues have not dropped as they've consolidated stores, which is interesting. So their existing stores, you could say, are getting stronger while they're getting rid of weaker stores, a la Seritage, I suppose, right? And I don't know where that trend ends exactly, but overall, they're in a pretty good cash flow position, which is always one of the first things they look at. And as long as they can kind of keep up, they don't need to grow at an explosive rate, but a big question will be how they do in like the next downturn. But I that's kind of like the main narrative I'm going off of, is they're in tune with like the sneaker culture, and I don't think they'll suffer because of that.
Interesting.
And multiples
it
are
looks,
really
yeah, I was going to say it looks cheap.
Yeah, and that was the first straw. Is it's the multiples are real low, so that gets me interested right away. Like, what's going on here? And if things look pretty stable and multiples are low, like, that's a good start. So that otherwise, though, I'm still putting most of my money towards Turtle Beach, but I think Foot Locker would be a close number 2 right now.
You've got a position in Foot Locker? Or?
I do.
Not yet. Okay.
It's probably my. Let's pull up my tracker again. It's like my.
I think it was 4.2%.
1, 2, 3, 4, 5. My fifth largest holding.
Yeah. What is it? 4.2%.
No, it is. I haven't reallocated. Probably about 7%.
7?
Mm-hmm.
Wow.
And then Turtle Beach is about.
Quran, you're having problems too? I'm having problems with the feed.
I can't hear Jack, yeah.
I guess it's just Jack.
Me?
You're back now.
Oh,
you were like in you were faded away. We could barely hear
that's
you.
odd. I don't know what that was.
Jack, is it getting brighter? Like,
No.
No. It seems there's a lot more sun. Anyway,
For me?
yeah. No, for Frank.
Oh,
Oh yeah, mine probably is. I've
Yeah.
got a window in front of me.
Okay.
Do I have my right? Yeah, I got my right microphone on, and so I don't know.
He's basking in the gains of KPG.
Yeah, we're approaching an hour here, so Jason Cron, we got to get your best ideas here.
Jason, go for it.
Okay, well, my best idea, and I mean this, is Prosus. It's been a long week. I'm not good at detailed numbers and all that kind of stuff. It's gone up in the last few days, but before it went up, maybe like 5 or 6%. My recollection doing this a few days ago was that you can buy Prosus. It is buying $1 of assets. 75 cents of those assets is 10 cents, and you can buy that $1 for essentially 54 cents. It's a way to get into 10 cent, but again, there's that huge discount on the net asset value. There's not a lot of debt involved in the situation at all. Prosus is net cash $3 billion or around there. 10 cent is net debt $3 billion, but that's very small for the amount of assets they have. Prosus is buying back shares. It's a super investor clone. The CEO of Prosus just bought $10 million, which I learned from you guys last week. So thank you for that. And Karan asked last week, what's the bear case for Prosus? Other than the regulatory risk in China, other than that, I don't really see the bear case. And I'm extremely enthused about it. And I feel like it has a massive margin of safety. It has upside, and I'm in love with it.
Jason, are you familiar with the fact that they just raised some money by issuing bonds?
Prosus or 10 cent? And
Prosus.
I'm not familiar with that.
In the chat, they've raised some money with Eurobonds.
Looks like 1 billion. Is it saying they've added $5 billion of debt?
Yep.
Okay, cool. I like that. I made a video the other day, I think, talking about Seritage, and at the end I talked about Prosus, and I talked about how I did not like the debt situation at Seritage. And even though one of my aspects that I like about Prosus and 10 cent is that there's not a lot of debt involved, I said I'm okay with them taking on more debt for them to do the things that they're doing. I feel okay about it. I like the management. I like the capital allocation. Question, do we know why they took on this debt? Is it to fund buybacks or investments, or just
it's
because?
It's at 2.77% for when's it mature? In 2034. That's lower than Jack's rate. I mean, why would you not raise money at these rates?
I see another $1 billion and $250 million at 5% due in 2052.
Yeah.
So I like it. And then a 1.2% note due in 2026.
That's like nothing.
Yeah.
I mean, Jack, you were at what, 2.9%?
Yeah, 2.99.
Yeah.
Plus a little bit of fees, but it probably ends up being 3.0 something.
So it sounds like everyone's pretty familiar with Prosus. I know Karan and Frank are shareholders, I believe. So that leaves the odd man out, the man sitting in Chicago, the man looking down at his computer.
Yeah.
Jack, do you not have FOMO thinking about Alibaba versus this Prosus situation with the massive discount?
Hey, maybe if I had more cash, but I'm pouring cash into. I'm pretty much fully invested. So as money comes in, it's going towards something. And I'm focusing a lot more on trying to find another real estate deal than adding more money to China. That's kind of the way it works. I get it's not technically China, but it kind of is. So
I gotcha. We have a question from Real Warren Buffett 69. I wonder if that's the man himself in Omaha. No way to know. He says, "What would you do if Monash sells out of Prosus? What would you do?" Jack, you and I were talking about this today when we did a recording on cloning. I would take it as a strong check-in point, and I would reevaluate the situation, but I would not just sell because he's selling. Like I do sometimes with my super investors. I am shameless enough to just buy because they buy before I've even looked at a company. Sometimes I do that if the price is right and if I feel like it. But with selling, I would just use it as a check-in point to reevaluate the situation. But I wouldn't necessarily just sell because he sells. I would be surprised if he sold. I would be surprised if he sold soon, because I know there's been a few investments lately where he's talked about them and then he's decided to sell. But I'd be surprised if he did it on this one. It sounds like the conviction is very, very strong.
I can throw out an interesting bear case for us. It more applies to Tencent, but of course, anything that happens to Tencent happens to Process. This is in the last few days, Pony Ma, CEO and founder of Tencent, had mentioned, it was in a private speech, and he said something along the lines of that Tencent is completely replaceable, and we've benefited hugely from the growth in China over the past 20 years. What do you make of comments like that from Pony Ma?
What I make about comments like that is that you think that is the most bullish thing you've ever heard about Tencent, and you love that the founder manager of that company is talking that way. I like that comment. It's the Amazon day one kind of thing. Now, any manager can say that, but with his track record, I feel like it's probably pretty backed up by that's the way he feels. And I think he's right. Reading about some of these other companies in China, like Douyin or whatever it is, their version of TikTok, it is obviously they have a massive moat. And the way I think about Tencent is it kind of seems like Apple, in the sense that Apple owns the operating system. And if everyone lives online in China through Tencent, they own that kind of operating system like platform. So the moat is very strong. They have all these investments. They have the video game stuff. But at the end of the day, if people start taking their eyeballs and their time each day and moving to other apps like this Douyin or whatever it's called, that does scare me. And it also scares me because I don't have the same grasp of the situation in China, the online situation, like I do in the United States. I don't know anything about those other companies, hardly, compared to what I know about like Facebook's position versus like TikTok here and stuff like that. So that is definitely a risk. I like that he's saying things like that, but yeah, no one's mode is secure forever. And it does seem like there is some powerful competition in the kind of like the way you spend your time online kind of space in China. So it is definitely a concern.
It's interesting from Pony Ma specifically because he's such a quiet CEO. He never addresses anything publicly. And again, this is from a private speech somewhere. I don't even know where, but it has been put out to the public either way. I think it's a bit of I think it's from Peter Thiel that says monopolies are always trying to say that they're not a monopoly, while non-monopolies are trying to prove that they are a monopoly.
Great quote.
And I think it's a bit of that from Pony Ma, particularly with regulatory crackdowns. So it's interesting either way. They also did just release their, I don't know the proper word for it, but the code for their operating systems for WeChat and everything else, and made that public. So they're kind of de-risking some of these regulatory things and kind of providing a spot for the market to enter as competitors, which I don't think concerns them whatsoever.
One thing I think a lot about Tencent these days is through video games and through their investments, it seems like they have this path to almost get out of China, if you will, with a lot of their capital and investing. And I'm very curious to see what they do over the next 5 years in terms of spreading that capital around the world. Because you think about a company like Fortnite. Fortnite, you think of this American company. They're in like North Carolina or South Carolina. Classic American story. Entrepreneur started a business. Now he's a billionaire. And then I read the other day, I'm pretty sure this is right, that like Tencent owns a big chunk of whatever owns Fortnite. So
Epic Games. Yeah.
Epic Games. Okay. And so it seems like they've got their tentacles, if you will, all around the world. And if they're going to grow, it seems like everybody already uses WeChat and WePay and all that in China. Now, I know there's the cloud potential in China, but I'm hoping that there's some massive growth worldwide in these investments. And maybe different products it can make around the world for people. That could be an awesome thing. And if Monish says that there's a chance they could be the biggest company in the world, they're going to have to do stuff like that, because I think their market cap, Tencent now, is like, is it like 500 something billion or something? So that's a long way away from Apple's almost 3 trillion. So if they are going to catch up, some interesting things are going to have to happen. Fascinating story, though. I've just I fell in head over heels. And by the way, I'm still in the honeymoon phase, so I don't want to think about these negative questions.
Yeah, you just bought.
Oh, I'm buying, Jack.
Still buying.
I am buying. I'm 27% allocation, and I'm buying everything I can.
The write-up I'm doing on Tencent at the moment, the research going into that for my newsletter is making me even more bullish on Tencent, like realizing it's even a higher quality company than I originally thought. Like, it's absolutely insane what they've done over the past few years. From their IPO, they've been a 45% annual return. So the credit to Pony Ma should be incredible for that. The book Outsiders, and I write about this in the newsletter, by William Thorndike, and he talks about the best 80 CEOs or capital allocators of all time. It has Buffett, it has Singleton, John Malone, people like that. One of the metrics he uses is total shareholder return annually over a long time period while the CEO is in place. And I think Pony Ma outperforms every single person in that book. It gets hard when you take someone like Buffett, who's done 20% for 60 years, and to compare that to 45% for 23 years. It's it's hard to judge something like that, but it's pretty insane either way.
Would you consider rolling Alibaba into Tencent, a la Monish?
A la After Dinner Investor?
Yes.
I personally wouldn't know. I think the cloud upside from Alibaba could make the returns well and truly better than Tencent. It's just far less uncertain and more risky. The quality is in Tencent by far. I feel more safe with my money in Tencent, but I think better returns could come from Alibaba.
If this cloud thing really happens, right?
If they maintain a 40% market share in the cloud market in China, I think it's almost guaranteed that the cloud business is worth more than the current market cap.
Frank, let me run this by you. On Amazon, there's a book coming out in June called Tencent, The Extraordinary Story of a Chinese Internet Enterprise by Wu Zhebo, if I pronounce that correctly. And we have The House That Jack Ma Built about Jack Ma, great book. But when I was looking and researching into Tencent, there's seems to be very little about Pony Ma and about the Tencent story in terms of books. So this looks like a serious book, and it looks like it's going to be in English. So it is going to be in English. So I've already pre-ordered it. I'm looking forward to diving into that this summer.
Yeah, I think that'll be great. I think Pony Ma's very underappreciated, particularly in the West, and because he is quiet and doesn't speak publicly barely at all, I think the story is pretty unknown. But I think he's top 5 capital allocators of all time, and by the end of his life, I think he could be towards number 1.
Frank, I have not done this yet, so it's something I need to do. So if you haven't done it either yet, no shame, because again, I haven't done it. But we heard Monish talk about reading the Naspers transcripts and their annual letters to see what Naspers management had said about Tencent. That's how he actually learned about Tencent, because he said what Tencent puts out is pretty quiet. Have you done that yet? And do you plan to do that if you haven't?
No, I haven't actually at all. It probably would be interesting to dive back that far. I did, through my research kind of during the founding, I write about the founding period of Tencent. I realized there's a lot more to that investment by Naspers than I realized. Without that investment, Tencent probably wouldn't exist today. They were going through a legal battle about changing their name. They cloned a company in, it might have been Israel or some other country anyway. They cloned the business. They virtually had the same name, and they went through a legal battle. They had a lot of costs for that. Server costs in China were insanely through the roof, and they couldn't afford They were a zero revenue business at the time that they were going through this. So they had, I think, maybe 100 million or 10 million users or something. Like they were a big platform, but no revenue. And that $60 million investment from NASP has pretty much kept them afloat. And one of the other investors had to kind of exit some of their position to allow Ponyma to remain a large shareholder in the company.
Wow. Yeah, I've got to go back and read those because it just sounds so interesting. So that's on my list. Have you come across the Vineyard Holdings 10-cent write-up?
Yeah, that's who I have on my podcast this weekend. Jordan Nell is his name.
Oh, wow.
It's that's the best write-up I've ever read in my life, I think.
Have you recorded it yet, or
no?
Okay.
Tuesday Australian time, I'll sit down.
Well, pass him a thank you from the After Dinner Investor, because that thing I try to promote it anytime I talk about 10-cent, because that's where it clicked for me, where 10-cent clicked for me. I actually kind of feel like I could understand their business, and beautiful, amazing write-up. My last question for all of you guys, how I'm 27% into Process right now, allocation wise. How high would all of you let your Process allocation, 10-cent allocation go if the prices kind of stay where they are? What would you feel comfortable with?
1,000 times what it currently is.
I'd be happy to go as high as maybe 15-20%. That's kind of what I wanted to be, but my portfolio's just performed well. Kelly Partners Group performed really well, so it's taken my allocation down to about 10%, or 12% maybe. So I'll be willing to go a little bit higher, but I don't plan on adding anytime soon. Just another thing that you'll probably like, Jason. So Jordan Nell from Vineyard Holdings. I hope I can disclose this. I think I'll talk about it on the podcast, but he owns Process, not 10-cent. So he did access it through the Process route as well.
Okay, good to know. Karan, how high would you go with this Process investment?
I'm at 15%.
Would you go higher if it stays the same price?
I've been just putting money into Discovery, so
okay.
Yeah, I prefer Discovery over Process.
Interesting.
Is that your best idea, Karan?
Yeah, but I'm not going to be talking about it still, so that's pretty much it.
I think if we get Tom and Brad back next week, we could continue this best ideas, get Karan's out
All
there.
right, let's do that. And for some reason, if you let the sixth man in again, I'm going to bring in tons of stuff about Discovery. I'm going to say wild, crazy things about Discovery, and I'm going to make Karan so mad, and he's going to think I'm so done. He's going to have to correct the record about Discovery and tell us what he sees there.
Hey, well, whether you're live or not, you can be in the chat roasting them.
Oh, I'll for sure be in the chat.
I'll keep putting it on the screen.
Can you guys please do me a favor? Like, this is why we do this. This is why we talk about investing with friends and peers. Please slow me down on Process. Please tell me there's risk I need to look out for. Besides the China regulatory risk and all that, and my odds on that are always about 10%. I think there's a 10% chance really bad things could happen to shareholders, but I think it's very likely they won't do that. Why should I not go 50% in this position? Why should I not do that? Like, I don't see downside besides the small risk. What do you guys say to that? Slow me down here.
As with any fund, there's always a chance the discount doesn't close, or at least not as much as you would want. That's always a risk. I don't really have anything concrete for as to why that wouldn't happen, but hey, it hasn't closed yet. So
the discount is not, I mean, it's irrelevant in a way for Process. Right.
I don't really expect the discount to close at all.
How could that discount sit at 54 cents? I don't see that happening. I mean, I think it's going to close to some extent. That just seems crazy to me. Like, you get your hands on a growing company, very, very low debt situation, and it just sits at half off all the time.
I think it will sit there for a long time. I think the tax implications of selling the 10-cent investment at some time period in the future is huge. I think the complicated structure between South Africa, Netherlands, and China, there's so many risks involved throughout that chain that it deserves a fairly big. It's pretty arbitrary what you choose that discount to be, but I wouldn't expect it to close, and I don't think you need it to. I think you're pretty much relying on the Tencent position to carry the returns, and then the additional upside that comes for free is the investment or the VC portfolio.
What would you
But the
say?
current discount is irrational. The current discount is the current discount is going to reduce, but it's not going to go, I think, more than like 20-25%. It's always going to stay at that 20-25% discount.
Do you guys think every time they sell off, whether it's like Process selling off or monetizing one of their own non-Tencent assets, the other 25 cents of the dollar, or anytime Tencent does this JD kind of stuff where they sell off portions of stuff they own and people actually see billions of dollars now available, do you think that helps? What does that do? Because it seems like it attracts attention, or it seems positive to some extent. But if they do more of that stuff, do you think people will get more interested?
It's the best thing ever for Process. I don't know. It's good for Tencent as well, obviously. But I think it's even better for Process because it gives them cash. They can hold on to their Tencent position, not have to eat up that tax implications by selling off slowly over time, which is what they really have to do. And they can buy back shares at a huge discount, or they can reallocate towards higher returns in their VC fund, which I would assume they can do. And they would have a big say in Tencent actually making these decisions to kind of these special dividends and things that could come out. But there's so many things that could happen with Tencent's portfolio to like make the market recognize value. You talked about Epic Games before. I think if they listed that company, it would be worth an insane amount of money. Whereas I would guess the market's valuing that at about, they've got a 40% position. They're probably valuing it at around $20 billion, which is very low for what it's worth, I think. There's a lot of things they could do.
Okay, last question about this, and then maybe I can give my take on Discovery, because I have a background with Discovery. With Prosus and their non-Tencent holdings and Tencent with their holdings, is there a real chance, maybe it's only 5% chance, a 3%, 10% chance, whatever, is there a real chance that the next Tencent, the next Alibaba is inside of Tencent right now or inside of Prosus, and we could actually not just get like a nice return from the Tencent situation, but actually possibly get like a 30 bagger, or 50 bagger, something crazy. In the next 2 decades, could something crazy happen with something that's hidden in there? Or given their management style and their investing style, could something happen? Or am I just dreaming?
I mean, I think even Koos Becker could not imagine how large Tencent would get when he was investing in it. So I think same situation here.
It could. If they're playing that game, you're saying it could. If they're playing that tech investing game. Okay.
I think Tencent, particularly within their portfolio, and then this goes on to apply to Process because they presumably have access to the same things. They're working with a database that is like 50-fold what anyone else would ever have access to kind of predict the future in the world of gaming and a few other kind of different things, that if anyone's going to pick this huge return, it's likely to be Tencent in that space. But they are very diversified into tiny dollar amounts into these companies. So how much value that creates, I don't really know. But if anyone was going to pick it, I wouldn't be surprised if Tencent did.
Cool.
Jason, have you seen the previous, like the older Koos Becker videos, the lectures that he's given to universities and stuff?
No, I need to look. I didn't even know there were videos of him out there. Are they on YouTube?
Yeah, they're on YouTube.
And this is the Naspers current chairman, former Naspers CEO. Maybe he's the CEO still, but he's the guy that made this investment in Tencent.
Yep.
Okay, cool. Yeah, no, I need to
Those
dig into that so much.
Those are fantastic. Yeah.
Yeah, cool. Yeah, thanks for those resources, guys, and those comments.
Or you want your last minute jab at Discovery, and then we could wrap up.
Oh yeah, it's not jab. So my history with Discovery is John Malone bought into Discovery.
Is someone getting static right now?
I can hear that too.
All right, it's gone. Try again.
Is that Brad or Tom just trying to?
Yeah, the ghosts.
I bought into Discovery at like $22, $23 a share a while ago. It was a pure John Malone clone. He had talked about Discovery in a CNBC interview in like 2019, I think. It was trading maybe at like 4 to 5 times free cash flow. and I thought it was a cool investment. I was a customer myself. I watch a lot of like HGTV and stuff. And I was like, okay, I can get a 23% free cash flow yield on my investment. I'll take that. It's a John Malone clone. I held it. I got lucky. Something happened with someone out there, and the stock price went up to 80. I sold half my shares at 80, and then I sold the rest at like 40. My interpretation of the situation, and Karan can let me know if I'm correct or not, is that you still have that Discovery company. You still have Discovery. It's run up recently a little bit, but it was basically maybe like a 20% free cash flow yield, something like that. Not a super growing company, and they have a lot of debt, but the debt goes all the way out John Malone style for decades and decades, and so it's not super risky. But you're getting a nice free cash flow yield, maybe an irrational one. Maybe Discovery should be worth more on its own. But now they're going to merge. They're going to merge with the Warner assets that AT&T is going to spin off, and they are going to create a competitor to Disney Plus and Netflix, and that competitor, primarily HBO Max. That's what I think they should do. That product, to me, it's a better product than Disney Plus. It's a better product than Netflix. I think they have better content. I think they have more diversified content when they spin it out. And I know for myself and the kind of content we watch in my home, there is a 100% chance that we're going to be locked into HBO Max happily for a super long time. And at some point, if the market values that combined entity anywhere close to Disney Plus with Disney and Netflix, it's going to be a super multi-bagger. But there's also going to be a lot of debt involved when they combine companies. So Karan, nod if you think I'm correct.
Yeah.
Shrug if you think I'm correct.
Sounds good.
we lost Frank. I'm not sure what happened there. He dropped. I don't see him in the room.
I think I'm just a bit skeptical about the merger working out. Until it's done, it's not done.
Karan, does this make sense? I've seen people say that they don't want the merger to work out, that they like Discovery. They think it's going to be good for Discovery on its own if it doesn't happen.
Everyone has an opinion. So
let me ask you this. When will you speak on Discovery? Because I'm very curious. And why haven't you?
Honestly, I don't have any great insight as opposed to what everyone else knows. So it's not like
he doesn't want to jinx it. He doesn't want
I'm
to jinx
just trying to
That's
avoid if I talk about something and then I change my mind about it later. It's basically for my own biases. It's not for
Gotcha.
any great insight or anything.
That is the danger we all run as creators. And once you put it out there, there's a pridefulness to it that's hard to shake.
Yep,
Yeah.
For
And
sure.
plus, I've seen 2 deals fail in the past year with
Equity
companies.
Commonwealth is one.
Yeah.
Urging
so
Square
I'm
number
just-
2, sort of.
I have a high confidence this deal is going to go through.
Same here.
They put so much time on the table. That's one reason I think the market didn't like the announcement, is because it was like this. I don't know. Was it the spring of 23 or something crazy like that? It was like a long time. And then why? Who's got beef with this deal? AT&T shareholders and management want it.
It's not them. So the whole Amazon MGM merger, the acquisition that had happened, I think there was some issue. If that goes through, then that could affect how the Discovery merger is perceived and all that. So,
you know what I've heard some people want is, some people think, and maybe I'm wrong on this, but I do remember hearing something that or maybe I'm just making this up, but until it's a done deal, doesn't that mean anybody else can come in and bid for Discovery if they want to?
I don't think so. I think the deal's
Or is
already
it
kind of
pretty locked
in
up?
place. It's pretty
Okay,
locked
cool.
up, yeah, and it's just going to. They already have everything just coming together. I mean,
Well, Discovery's price came all the way back to $21, $22 a share, which I think was crazy. And I'm actually kicking myself that I didn't get into it when it came back, because that high free cash flow yield thesis that I had is still there. But now it's already back up to 30, and I'm a little nervous that I kind
so
of
what's preventing you from averaging up? Because
I
it's
sold
still-
out totally, so I'm not in it right now.
okay.
Part of it is I've been into Tencent. I do have a holding, Green Brick Partners, which is a home building company. Seems to be a growing company. Seems to have a lot going for it, a lot of insider buying. But my conviction has dropped in that lately, just because it feels a little bit too outside of my core circle of competence versus Discovery. I kind of get, honestly, with Discovery, and maybe it just takes 2 hours of work, but I've had a problem picturing what that company is going to be worth when it combines with the Warner assets. And maybe it's because we don't know what it's going to be worth until it starts trading on the market. But that whole merger thing, it's just been different. It was just different. I don't have experience with that happening. My experience with mergers is one company comes in and says, hey, we're going to buy a company for $10 a share. It's trading at $5. And you're like, okay, when they buy it, it's going to be, people are saying it's worth $10 a share. I'm having a little trouble with that. And the other thing that scares me away a little bit is there is a ton of debt, I think, that is coming with Warner. And then even though me personally, I would choose HBO Max versus these other companies, Netflix and Disney Plus, man, those are big companies and they have very lenient shareholders. And it just, Netflix has been so quiet lately. I just feel like maybe they'll get aggressive, and I don't know if I want to compete with them. And another thing that bothers me is John Malone talks a lot about not focusing on the super app, and maybe they do that, but having a lot of different options. Like you can buy CNN itself and pay $1 a month, but you have to get some commercials. And to me, that doesn't seem that attractive. That doesn't seem like the future of TV, and that doesn't seem like a cool differentiated product like the super app there, where almost every household in America pays like $15 a month or something because there's something for everyone in the house, and they kind of do that Netflix model. And honestly, the final thing that scares me is the content business in the streaming era. It just seems tough. Like it seems like you're always throwing a lot of money at it. It's just, man, when it got down to $21 again, I was like,
the legacy content has a lot of value. That's
true. One reason I subscribe to HBO Max is because Sopranos are on there. And I know they might be in other places, but I just like having ownership, if you will, that way, to be able to watch it anytime I want. Karan, do you watch The Sopranos?
I don't know. I don't watch TV, surprisingly. Yeah.
It's a great American drama. Jack, have you watched that series?
I actually have not. I'm like Karan. I barely watch TV. It's all YouTube, and then during the baseball season, a good amount of baseball.
I'm just keeping up with Brad's videos,
Yeah, right.
Someone made a comment earlier about Brad's recent Bitcoin video about Bill Miller and Bitcoin. Yeah. Interesting video. One of the things he said was that someone asked Bill Miller why he likes Bitcoin over gold. And at least my understanding of Brad's reporting on the answer, so this is like third, fourth hand now, is that Bitcoin has gone up more than gold in the last decade, and therefore that makes Bitcoin more attractive. I didn't really get that, but it was an interesting video.
I love when people make that argument for anything. Like, it's gone up in the past 10 years. It's like, so what about the next 10? And like,
yeah,
it's always hilarious that that's a selling point. I always hear it on like all the ads, the highest performing financial asset of the last decade. It's like, okay, thanks.
What's up, stock compounders? Brad here. Do you guys prefer that one, or do you prefer the yo? What is up, stock compounders? Brad in the hizzy.
Welcome to Compound Town.
Does Brad own Bitcoin? We don't know.
I'd be surprised.
He's never disclosed it. Yeah.
I'd be surprised, but he seems to be intrigued with the space. I would say that's fair. I think he's done.
I think it was after the Guy Spear interview.
Yeah,
that triggered like the.
Oh, the Guy Spear owns like $100, doesn't he? It's like that.
I'm not sure. I will say this: I'm reading a great book about Peter Thiel right now called The Contrarian, and there's a very interesting theme with things like PayPal, like Bitcoin, like gold. It seems to be a human concern about fiat currency.
Mm-hmm.
Like humans are always going to have that concern.
Yep.
And whether it's a valid concern or not, it seems like every 20 years, something will come along. And the pitch will be that this is outside of governments. Governments can't print this currency away. They were talking about PayPal like that in the beginning. And man, if it does seem like that's a pattern, and I feel like now it's very easy to say this because we've all seen what Bitcoin does, but I feel like now I would be tempted to go in like a 1 or 3% position wherever there's something like a bunch of energy in that space where people are making that pitch, and it seems like there's a crazed cult-like atmosphere, because it seems like when it catches on, it really does catch on for a long time. And it's so easy to justify making like a 1 or 3% bet because you're like, I'm going to compound at 20% anyway this year. What's 1 or 3%? But easy to say now, of course. But I am understanding the argument more.
That's basically what I'm doing. I'm throwing 100 or I think $200 now per month.
Yeah, but Brad, it ain't okay. I thought you were gonna say it was sorry, Brad. Jack, I thought you were gonna say you were doing that with all your investments. You're throwing 3%.
Yeah, but for a while, yeah, it was
1% here, 5,000 to 1.
It was that for a while.
I was like, Jack, it ain't gonna be Foot Locker. That's not gonna be the 5,000 to 1.
No, definitely not. But to that like Peter Thiel like 20-year cycle thing, what always seems to end up happening with just how currencies work is maybe you have something backing the currency. That's what we had for most of human history. But then you have something in front of the currency that's actually used day to day, like money. And that's what it's still, they find ways to abuse that, or you just get into all these derivative territory. And it's not as though having something backing the currency will suddenly rid us of all problems. Like people are already trying to do that with Bitcoin. They have different sorts of cryptocurrencies that are all centralized in front of it with Bitcoin backing. It's like, okay, how much are you really helping right here? That's very close to what we had with the gold standard in the US. You had dollars in front of it with gold theoretically behind it. But even that was abused because the government could like arbitrarily pick the price of gold. So like you run into problems even when you have backings, and what comes out of the fiat system if it doesn't just stay fiat for the rest of our lives. I'm not sure if it goes back to anything like that, but probably, because that's what's been the sort of status quo up until basically like 1970, really kind of before that. Once the Fed became a thing, it was still technically gold backed, but that's when kind of all the abuses started happening, if you want to call it that.
Yeah.
Real Warren Buffett says Brad is he's busy selling NFTs right now.
Yo. He can sell that part of it. He can sell the what is up stock compounders part. You get to own that call out on each video he does. You get to own that one.
You get the royalty on that.
Yeah, he sells his intros or the URL to the MP4 file of the
I gotta say, intro. My favorite one of my favorite things about Brad's videos are his backgrounds. They seem to be different quite often.
Yeah.
And he did this epic one when he was on vacation, where he was like posted up at a villa somewhere, and it just made me want to watch the video. It was great.
I don't know if I remember that. The one I remember excellent. Most distinctly is it was like real late at night when he was filming. Clearly, it was super dark, and he had like I think it might have just been the screen like lighting his face. So it's
very
like
ominous vibe.
Yeah, it was like a campfire vibe, and it was really funny. Like he's out in the middle of a forest with a campfire.
He's like unintentionally like an amazing like YouTube producer from that aspect.
Yeah,
of it,
like that vibe.
Aspect.
It's a cool vibe that he has. It's like low effort but good. So it works. And he's proud of it. He's proud that he doesn't edit.
Guys, I don't spend my time on the editing, guys. I focus on the content, the real thing we're all learning from, guys. That's what I focus on.
You got a pretty good Brad.
I got a pretty good Brad.
I have a good double speed Brad because that's how I listen to him. So
no, Brad speaks on the same words per minute as me. That's for sure. Yeah.
Yeah. All right. I think that's a good spot to wrap it up. We're an hour and a half now, and I'm trying to get to bed. It's late for us here on U.S. Central Time, Jason. And
I think I'm going to go watch a House Hunters with my wife, and we'll think about how we're giving Karan all our money as one of his customers.
Why are you not buying Discovery again? We never got to that.
Well, because
we're going to go in another 15 minutes.
Because listen, like 27% of my portfolio is processed now. 20% is Apple. I've got this stuff in Ring Energy and Pedevco, which is like oil, and I'm waiting for that story to continue playing out. You got me curious. I'm just gonna pull up my portfolio real quick.
Seen the MOI presentation? The new presentation that's out.
No, what is that?
I'll send it to you. Yeah.
Send it to me, please. Yeah, is this for a presentation on Discovery?
Mm-hmm.
Okay, yeah.
It'll help with the part that you were talking about.
And
the business.
Okay, so I'm going to look at that. I'm open to it. And I know you don't have to sell all your stock to buy something else, but I got a huge position in Racis in Turkey. Don't feel like selling that.
How's that going?
What kind of question is that, Karan? What a rude question. Honestly, I think
you can buy some donor with probably the funds that remain. Like just get like a nice Turkish.
The business is doing just fine. That's what's going on with that.
And the value is intact.
The stock is actually up 40%, 30% since I bought, and the currency might be down like 50, 55%. So that's what's going on with that.
Alrighty, boys. That's enough.
Can you share site to track your?
Yeah, hey, we have a link to share site for all you happy campers who are still with us. An hour 35 into it now. And you can see our portfolio. It hasn't done too well over the past couple of months, but if you sign up using that link, you can get a few months free for their premium version. So go ahead and check that out. Sharesite.com/punch card investing. Otherwise, smash that like button as you fine folks always do. We appreciate it. Subscribe if you haven't already by chance, and hit the bell icon so you don't miss any future notifications. And that's all I got. Thanks for joining us again, Jason. And otherwise, I'll see you all soon.
Take it.